Our central banks are in crisis. Here's why it matters. For decades, central banks have traditionally been regarded as the primary guardians of economic stability. When crises appeared, they intervened during periods of economic distress. They lowered interest rates. They increased the money supply. They implemented measures to stabilize financial systems. They worked to restore stability in financial markets. And for a while, these interventions appeared effective for a period. However, recent developments indicate a shift in the effectiveness of these strategies. Inflation is rising. Debt levels are increasing at an unprecedented rate. Public confidence in central banks is declining. Central banks globally are confronting challenges that may exceed their capacity for effective management. Because after years of emergency interventions, the financial system may now exhibit dependency on ongoing intervention. This situation represents a concealed crisis within contemporary central banking. The implications of this crisis are significant for all individuals in the current global economy. The term central bank is widely recognized. Yet the specific functions of central banks are not widely understood. Institutions such as the Federal Reserve, the European Central Bank, and the Bank of Canada occupy central positions within the financial system. Their primary responsibilities are often described as follows: maintaining price stability, supporting employment, and protecting confidence in the financial system. Central banks primarily achieve these objectives through a key policy instrument: the adjustment of interest rates. During periods of economic slowdown, central banks typically lower interest rates to encourage borrowing and stimulate spending. Conversely, when inflation increases, they raise interest rates to moderate economic activity. In theory, central banks function as economic stabilizers. However, recent economic crises have expanded the scope of central banks beyond their traditional roles. The modern era of aggressive central banking accelerated following the 2008 financial crisis. The global financial system was on the verge of collapse. Several banks failed. Credit markets froze. Widespread fear followed. Central banks responded with unprecedented intervention. Interest rates were reduced to near zero. Central banks then adopted even more aggressive measures. They implemented quantitative easing. Central banks created large sums of money electronically to purchase government bonds and other financial assets. This injected trillions of dollars into the financial system. Markets subsequently recovered. However, this created a significant new dependency. Low-cost borrowing became the norm. Governments increased their borrowing. Corporations also took on additional debt. Investors assumed greater risk. Asset prices rose sharply. This included stocks, real estate, and debt markets. The global economy became increasingly reliant on low interest rates. Once financial systems become dependent on low-cost capital, raising interest rates becomes extremely challenging. The subsequent shock then emerged. This shock was characterized by inflation. Following several years of expansive monetary policy, the implementation of pandemic-related fiscal stimulus, widespread supply chain disruptions, and heightened geopolitical instability, global prices experienced a significant surge. Central banks were abruptly confronted with a policy dilemma. If interest rates remained low, inflationary pressures could intensify further. Conversely, if rates were increased aggressively, there was a substantial risk of destabilizing economies heavily reliant on debt. This marked the onset of a more profound crisis. Modern economies are now characterized by significant leverage. Governments have accumulated substantial debt obligations. Corporations similarly maintain high levels of indebtedness. Consumers also carry significant debt burdens. Even modest increases in interest rates now exert considerable pressure across the entire financial system. As a result, central banks are constrained by two primary risks: persistent inflation or the threat of financial instability. Neither policy option presents an easy political solution. Modern money systems operate largely on confidence. Most currencies today are not backed by gold. They are backed by trust. Trust that governments remain stable. Trust that inflation remains controlled. Trust that institutions remain credible. Central banks depend heavily on this confidence. Because if people stop believing central banks can control inflation, they would lose confidence on the system. This is why communication has become so important. Today, central bankers do not only manage economies. They manage psychology. Markets react to speeches, interviews, press conferences. Even a single sentence from a central bank official can move trillions of dollars globally. Because confidence itself has become part of the system. And once trust weakens, financial systems can destabilize very quickly. Central banks were established with the intention of maintaining institutional independence. The idea was simple: politicians focus on elections. Central banks concentrate on ensuring long-term economic stability. However, in practice, the relationship has become increasingly complicated. Governments depend substantially on debt financing mechanisms. Elevated interest rates significantly increase the cost of servicing government debt. This creates enormous political pressure. When interest rates increase, adverse economic consequences often ensue. Business activity tends to decelerate. The housing sector typically experiences a downturn. Unemployment rates may increase. Financial markets may decline, and voters become angry. Consequently, central banks encounter a highly challenging balancing act. They must address inflation with sufficient rigor to maintain institutional credibility, while avoiding the onset of a severe economic crisis. The problem is that years of easy money may have delayed pain rather than eliminated it. Currently, the financial system may be facing the cumulative consequences of these policies simultaneously. Central banking is often perceived as relevant only to economists. However, decisions made by central banks influence nearly every aspect of daily life. For example, mortgage rates are directly impacted, savings account returns are also affected, stock market performance is influenced by central bank policies, pension values can fluctuate in response to monetary policy changes. Housing prices are shaped by interest rate adjustments, inflation rates are a direct consequence of central bank actions. Employment levels are also influenced by monetary policy. When central banks increase interest rates, the cost of borrowing rises. When they print money aggressively, purchasing power may decline over time. This means the crisis inside central banking eventually reaches ordinary people. Especially younger generations, many now face rising living costs, elevated housing prices, and economic uncertainty unlike previous decades. Furthermore, there is a growing trend in which people are beginning to question whether the current financial system remains sustainable long-term. Central banks were established to promote economic stability. For several decades, they became more powerful after every crisis. However, the global economy may now be entering a new phase, one where inflation, rising debt, aging populations, geopolitical conflict, and slowing economic growth, all occurring simultaneously. The challenges currently confronting central banks may extend beyond purely economic concerns. These challenges may be structural in nature, because modern economies have become deeply dependent on financial intervention, and the longer emergency policies continue, the harder it becomes to return to normal. The central issue is no longer the relevance of central banks. Instead, the critical question is, can the current economic system function effectively without continuous central bank support? If it cannot, what are the potential consequences? And this is a difficult question to answer.